Everyone in the silver community right now is pointing at Iran. Peace talks collapsed again, dollar spiked, silver dropped, case closed. That's the explanation filling every financial headline on Tuesday, April 28th, 2026. And it's wrong. Not partially wrong, completely wrong. Iran is the excuse. What the Federal Reserve did 3 weeks ago is the actual cause. And the difference between understanding the excuse versus understanding the cause is the difference between making money on silver this week and losing it. Let me show you exactly what happened, when it happened, and why the silver community missed it entirely. Go back to April 7th, 2026, that specific Tuesday. Silver was trading at $70 per ounce. The Iran war had been running for 5 weeks. The Hormuz blockade was active. Oil was near $100. Nothing about the geopolitical situation was materially different from what it is today. But something changed on April 7th that didn't make headlines in silver circles because it happened in the Treasury bond market, not the precious metals market. On April 7th, the CME FedWatch tool showed a 22% probability of at least one Federal Reserve rate cut before the end of 2026. That 22% was the market's baseline assumption for the entire first quarter of 2026. Every silver price model, every analyst forecast, every institutional position in silver was built on the premise that the Fed would cut rates at least once this year. That single assumption was the foundation of the bull case for silver above $80. 3 weeks later, on April 28th, 2026, today, that 22% has gone to zero. Not 5%, not 2%, zero. The CME FedWatch tool now shows no rate cuts expected until mid-2027. FX's Street confirmed this in their April 27th analysis with one sentence that should have broken the internet in silver circles but didn't. CME FedWatch latest Fed rate probability points at no rate cut until mid-2027. The market went from pricing one possible cut in 2026 to pricing zero cuts for the next 15 months in 3 weeks. And silver fell from $79 to $73 during those exact 3 weeks. The Iran situation didn't change meaningfully in that window. What changed was the complete elimination of rate cut expectations from the 2026 calendar. Now let me show you the mechanics of why this matters more than any geopolitical event. Silver is a non-yielding asset. It pays no dividend, no coupon, no interest. When you hold silver, you give up the return you could have earned holding treasury bonds or money market funds. That opportunity cost is called the real interest rate, which is the nominal interest rate minus inflation. When real rates are negative, meaning inflation is higher than the interest rate, silver has no opportunity cost. You're not giving up anything by holding it because cash is losing purchasing power faster than the interest rate compensates. When real rates are positive, meaning the interest rate is higher than inflation, silver has a cost. You're giving up real yield to hold a metal that pays nothing. Institutional investors, who manage trillions of dollars and have fiduciary responsibilities, cannot justify large silver positions when real rates are significantly positive. Their mandate requires them to maximize risk-adjusted returns. Silver at zero, yield versus treasuries at 4.27% with 3.3% inflation means real rates are approximately positive 1%. That's not devastating, but it's enough to reduce silver's attractiveness at the margin. Here's where the Fed's 3-week shift becomes catastrophic for silver. When the market believed one rate cut was coming in 2026, the forward real rate trajectory was declining. Even if current real rates were positive 1%, the expectation that rates would drop by year end meant silver buyers were positioning for a more favorable environment ahead. They were buying today in anticipation of tomorrow's better conditions. When that rate cut disappears from the calendar and gets pushed to mid-2027, the forward trajectory flips. Instead of improving conditions ahead, you have 15 months of unchanged or worsening opportunity cost. Institutional models that were pricing silver at $80 or $85 based on an improving rate environment now have to reprice for a static or worsening rate environment. The repricing target drops to $70 to $75, and that's exactly where silver is right now on April 28th. Iran didn't do this. The Fed's credibility data did this. Let me show you the specific sequence of economic reports over the last 3 weeks that eliminated the 2026 rate cut. April 10th, March CPI released. Headline inflation came in at 3.3% year over year. Core CPI, which excludes food and energy, was 3.0%. Both numbers were above the Fed's 2% target. But more importantly, the month-over-month core CPI was 0.3%, which on an annualized basis is 3.6%. The Fed needs to see month-over-month core inflation consistently at 0.17% or lower, which annualizes to 2%, before they can justify cutting rates. March's 0.3% monthly reading was almost double the target rate. April 11th. The University of Michigan released preliminary April consumer sentiment. The headline number, 50.8. That's near historic lows. But the data point that killed the rate cut was the one-year inflation expectation, 4.6%. Consumers expected inflation to average 4.6% over the next 12 months. That reading was later revised to 4.8% in the final April release last week. When consumer inflation expectations are at 4.8%, the Fed cannot cut rates without risking a complete loss of credibility. If you cut rates while consumers expect 4.8% inflation, you validate their fears and potentially trigger a self-fulfilling inflation acceleration. April 16th. March retail sales released. Headline retail sales rose 1.4% month over month, significantly above the 1.3% forecast. Strong retail sales signal that consumer spending remains robust despite high prices. A strong consumer means the economy doesn't need emergency rate cuts to prevent a recession. The Fed reads strong retail sales as permission to hold rates longer, and that's exactly what happened. Those 3 reports in 6 days eliminated the 2026 rate cut. Not Iran, not the dollar. Economic data showed inflation still running hot, consumer expectations unanchored at 4.8%, and consumer spending still strong enough to not require emergency Fed intervention. The 22% cut probability went to 0 on those 3 reports between April 10th and April 16th. Silver peaked at $84 on April 17th, one day after the retail sales report confirmed the rate cut was gone. The timing is not a coincidence. Institutional models repriced simultaneously. Silver has been falling in an almost straight line from $84 to $73 over the 10 trading days since. Here's what makes this analysis even more critical for the next 48 hours. Tomorrow, April 29th, Jerome Powell holds his final Federal Reserve press conference as chairman. His term ends May 15th. This is the last time he speaks in his official capacity as the most powerful central banker in the world. The silver community is treating tomorrow's press conference as a binary event. Hawkish means silver falls, dovish means silver rises. But that's the wrong framework. The correct framework is this. Can anything Powell says tomorrow restore the 22% probability of a 2026 rate cut that was eliminated 3 weeks ago? And the answer is almost certainly no. Here's why. Powell cannot signal rate cuts while core inflation is at 3.0% and consumer expectations are at 4.8%. If he does, he destroys the Fed's inflation-fighting credibility in his final weeks as chairman. He writes himself into history as the man who broke the Fed's credibility on the way out the door. His legacy incentive is to sound balanced but not dovish. Balanced means the rate cut stays off the table. Rate cut off the table means the mechanism that drove silver from $79 to $73 stays in place after tomorrow's press conference. But here's the twist that changes everything. Thursday morning, April 30th at 8:30 a.m. Eastern, Q1 2026 GDP releases simultaneously with core PCE inflation and the employment cost index. This triple data release is what actually has the power to restore the rate cut probability. And here's what the data is likely to show. GDP consensus forecast is 2.2% growth. But look at what happened to Q4 2025. The advance estimate was 1.4%. The final revised number, confirmed recently, 0.5%. A 64% downward revision. The Q4 economy was 3 times weaker than initially reported. Q1 2026 includes the first full month of Hormuz disruption in March. Oil near $100. Consumer confidence crashing to the 47.6 all-time record low, and IPA tariffs that reset global trade costs. The conditions for a Q1 GDP miss are overwhelming. If Q1 GDP comes in at 1.5% or lower instead of the 2.2% consensus, the rate cut probability doesn't just return to 22%. It could jump to 40% or 50% within hours. A 40% rate cut probability means institutional silver models that currently support $73 immediately reprice to $80 or 82s. That's a $7 to $9 silver move in one morning. And if core PCE simultaneously comes in above 0.3% monthly, you get the stagflation signal. Weak growth plus persistent inflation. That combination doesn't just restore the rate cut probability, it triggers a completely different silver narrative. Not rate cuts are coming, so silver will rise, but the Fed is trapped and silver is the only asset that survives stagflation. These are 2 different bull cases with different magnitudes. The rate cut bull case takes silver to $82 to $88. The stagflation bull case takes silver toward $100 and beyond. Thursday morning is where we find out which scenario we're in. Now, let me show you a data point from this week that nobody in the silver community is connecting to the price action. The U.S. military has depleted approximately 50% of its most expensive precision-guided missile inventory during the Iran conflict, according to Fortune's reporting on April 27th. The missile types affected include Tomahawk cruise missiles and JSSM extended-range munitions. These systems contain silver in their guidance computers, inertial navigation systems, and radar components. Here's the connection to the Fed. Rebuilding those missile stockpiles requires emergency defense procurement. Emergency defense procurement requires congressional appropriations. Congressional appropriations add to the federal deficit. A larger federal deficit means more Treasury bond issuance. More Treasury bond issuance puts upward pressure on yields. Higher yields mean real rates stay elevated for longer, which is the exact mechanism keeping rate cuts off the table and suppressing silver's paper price. The Iran war is creating a fiscal situation that reinforces the Fed's inability to cut rates. The war's direct impact on silver through defense procurement demand is real and significant. But the war's indirect impact, through fiscal pressure on Treasury yields and Fed policy, is the mechanism that actually explains the price action. Iran isn't suppressing silver because of peace talk failures. Iran is suppressing silver because the war's fiscal cost is keeping interest rates higher for longer. Let me give you the mortgage rate data that confirms this transmission mechanism. According to Wikipedia's economic impact data, the 30-year mortgage rate climbed to 6.38% on March 26, 2026. Housing affordability is near multi-year lows. When mortgage rates are 6.38%, housing starts slow, construction material demand falls, and the economic multiplier from real estate contracts. That economic contraction is exactly what should push the Fed toward rate cuts. But inflation at 3.3% prevents the cuts. The Fed is watching housing contract in real time and cannot respond with the traditional tool of lower rates. That is stagflation in action. And it's a direct consequence of the Iran war's fiscal impact on interest rates. Here's another data point from today, Tuesday, April 28th, that changes the silver supply picture in a way nobody is discussing. The Durable Goods Orders Report releases at 8:30 a.m. Eastern today. March durable goods includes defense orders, and here's what the March data is expected to reveal. Aircraft and defense procurement orders surged in March as the Pentagon fast-tracked weapons replacement programs. When defense procurement surges in the durable goods data, it creates an immediate pipeline of silver demand that flows through to component manufacturers over the following 6 to 18 months. Defense electronics manufacturers like Raytheon, Northrop Grumman, and L3Harris are currently receiving accelerated contract awards for missile guidance systems, electronic warfare components, and radar modules. All of these use silver. The pipeline of silver demand from emergency defense procurement that will show up in today's durable goods data is not in any analyst model for 2026 or 2027. It's new, it's structural, and it's directly traceable to the same Iran war that everyone is blaming for silver's price drop. The same war that suppressed silver's paper price through dollar strength and fiscal pressure is simultaneously creating the largest new silver demand source in defense electronics since the Cold War buildup of the 1980s. That's the paradox at the center of the April 28th silver market. The bearish force and the bullish force have the same origin. Now, let me address the Magnificent Seven earnings tomorrow night, because this is where silver's biggest long-term demand story gets confirmed or questioned. Microsoft, Alphabet, Meta, and Amazon collectively report Q1 2026 earnings after the market close tomorrow. Combined AI infrastructure capex from these four companies in 2026 is projected at $670 billion, but here's the specific data point that matters for silver. Microsoft guided for Azure cloud revenue growth of 37% to 38% constant currency in Q2 fiscal 2026. If Azure actually grows at 37% in the quarter reported tomorrow, that confirmation of AI demand velocity means the $670 billion capex plan doesn't get cut. It potentially gets raised. Every percentage point of Azure growth above guidance translates to additional data center build-out above current projections. Additional data center build-out means additional silver demand in circuit boards, cooling systems, power distribution, and networking hardware. The silver consumption embedded in AI infrastructure is not visible in traditional commodity models because it's spread across thousands of component categories rather than appearing as direct silver purchases. But here's the bear case for tomorrow's earnings that silver investors need to watch. If any of the four companies signals AI monetization is lagging the capex investment, meaning they're spending $670 billion but not generating enough revenue to justify it, you could see capex guidance cuts. Netflix already missed last week and dropped 10% in one session. If Microsoft or Alphabet shows AI revenue disappointment, the AI infrastructure build-out narrative takes a hit, and with it, one of silver's most important long-term demand pillars. Watch specifically for Microsoft's Azure growth rate tomorrow night. If it comes in below 35%, that's a warning signal. If it comes in above 40%, that's an acceleration signal. The difference between those two outcomes is meaningful for silver's industrial demand trajectory through 2027. Let me close with a complete picture of what's actually happening on April 28th, 2026, because every piece of data I've shown you today connects to one central thesis. 3 weeks ago, the Fed's rate cut probability went from 22% to 0 because economic data showed inflation still unanchored and consumer spending still resilient. That single shift repriced silver from $79 to $73 and had nothing to do with Iran. Iran is the excuse the market uses to explain what the data actually caused. Tomorrow, Powell speaks for the last time as Fed chair. He cannot restore the rate cut without destroying his credibility. His words are neutral to slightly hawkish at best. Thursday morning, GDP either confirms the stagflation thesis or refutes it. If GDP misses the 2.2% consensus while core PCE stays hot, the rate cut comes back into 2026. And every institutional model that repriced silver to $73 has to reprice back to $80 plus. If GDP beats consensus at 2.5% or higher, the rate cut stays in 2027. Silver stays in the $70 to $70 range for another month. The $70 floor has held 3 times in 2026. The COMEX registered inventory is at 76.88 million ounces against 235 million ounces of delivery demand. The Shanghai physical price is at $88 to $90 against a $73 paper price. The structural deficit is 46 million ounces in 2026, the 6th consecutive year of shortfall. The cumulative 6-year drain is 762 million ounces. Nearly an entire year of global production consumed from existing stockpiles. None of that changed because Iran peace talks collapsed on Monday. What changed 3 weeks ago was one number on one website. The CME FedWatch rate cut probability dropped from 22% to 0. That's what crashed silver to $73, not Iran. The Fed did it 3 weeks ago, and Thursday morning is when we find out if the data forces them to take it back. That's the hidden truth behind the April 28th silver crash, and now you know it.